Welcome to video 4 in the series, What Does FIRPTA Refunds Do? My name is Richard Kahn, Director and one of the experts here at the firm. This is scenario 4 out of 4 possible scenarios clients bring to us. This video explains the FIRPTA treatment of a foreign investor who is a shareholder in a U.S. company that owns and/or operates U.S. real property interests and pays gains and income distributions to the foreign investor. Foreign investors are persons subject to FIRPTA, and they include non-resident aliens, foreign corporations, partnerships, trusts, estates, and other foreign entities such as purchaser, agents, and settlement officers. In the series in scenarios 1, 2, 3, we have a buyer purchasing property from a foreign seller. In this scenario 4, we have a payer who owns and operates U.S. real property. The payer pays the money and the foreign investor receives the money. In the case of a foreign investor as a shareholder, which we have here, they are the entity receiving payments from the corporation, partnership, or entity running the business and/or trade in the U.S. Under FIRPTA, the payer is a U.S. company. By company, we include privately held structures such as corporations, LLCs, and partnerships, otherwise known as non-publicly traded entities. There are some exceptions, which we will address specifically on our website. The U.S. real properties can include actual property types, such as residential and commercial in the two main obvious groups. Residential includes single-family, vacation home, sometimes called second home, condos, townhouses, and condotels, which are condos that have front desks. Commercial includes office buildings, hotel, retail, multifamily, land, industrial, and special purpose like gas stations and buildings to suit businesses such as bowling alleys and the like. We offer detailed types within these property subcategories on our website in the Do You Qualify Types of Real Estate section. But U.S. real property interests under FIRPTA are far more complex and include far more potentially capital events taxable to foreign investor ownership, in addition to the simple gain or sale of a piece of real estate. The simple gain or sale of a piece of real estate, known as a U.S. real property interest or U.S. RPI, gets more comprehensive in taxable events. It includes and excludes when foreign investor shareholder interests are considered. U.S. RPI includes not just the real estate, but improvements relating to structures and structural components relating to operation or maintenance. It also includes unsevered natural resources such as mines, wells, timber, crops, or other natural deposits, and property associated with these, including movable walls and furnishings. Unsevered means until such valuable crops, etc., or wells, water, oil is removed from the resource. So while it's on there, it's a U.S. RPI. And any interest other than solely as a creditor, meaning lending money in any domestic U.S. corporation that is or was a U.S. real property holding corporation within 5 years preceding the taxable disposition. Examples of types of ownership include fee ownership, which would be that in the simple real estate transaction. Then you have co-ownership, you have leasehold interest, you have timeshares, life estates, and remainders or revisionaries, which are future interests from an estate. You have options and equity kickers. Equity kickers are interesting. These are features of a loan that provide percentage ownership or additional income from the property under certain realized gains achieved because of the loan. FIRPTA applies to U.S. real property holding corporations' taxable events. We run tests to determine if the taxable operations are those of a U.S. real property holding corporation. By the way, the PATH Act of 2015 increased the exemption of foreign ownership in publicly traded stock that is not taxed as U.S. real property interests of a U.S. real property holding corporation if the shares owned are less than 10% of the corporation's traded stock. The point being, exemptions apply. Effectively connected income, usually referred to as ECI, to U.S. real property interests, includes more than a direct interest in real estate. To determine what kinds of income which are treated as taxable ECI, we run tests such as the asset and business activities tests based on examining the nature of activities. Tax deductions are allowed against ECI. Then you have the FDAP, the fixed determinable annual or periodical income, which is income other than the gain or sale of real property and personal property. FDAP is income from U.S. real property interests that is fixed and paid in known amounts ahead of time. For example, determinable, meaning the basis exists for figuring the amounts payable, amounts paid annually or periodically from time to time. FDAP for foreign persons and entities is income from operations except those from the gain and the sale of real estate and real property. There are also exemptions such as income from tax exempts, munis, etc., and money from scholarships or insurance claims, or stock and secure transactions of securities and commodities and hedges made through U.S. brokers. It can get complicated from the uninitiated point of view because certain kinds of FDAP may be ECI for income purposes but not treated for ECI or as ECI for FIRPTA withholding purposes. So when the payer pays the foreign investor gains or income, the payers must withhold 15% from the payment. FIRPTA, the Foreign Investment in Real Property Tax Act, created by Congress in 1980 and modified by the PATH Act in 2015, requires this to ensure a foreign entity, files a tax return and pays taxes. These are the laws upon which the IRS requires the payer, in this case, to withhold 15% from taxable payments the foreign investor receives, with very few exceptions, and remit the withheld funds due the seller to the IRS within 20 days of the payment. Which withholding is almost always going to be much more than the tax due because the withholding is on the gross disposition and not the tax only on net gains. And if the foreign investor doesn't file for the full refund, the 3-year statute of limitations runs, empowering the IRS at that point to keep the withholding for themselves after 3 years from the payment date. Our policy is to try and obtain the most refund for the foreign client that the law permits. Foreigners such as non-resident aliens and their entities are required to provide the IRS with their ITIN. FIRPTA Refunds assists our foreign clients in applying for and obtaining the required individual tax identification number, ITIN, as well as renewing theirs if they have one that was issued more than 3 years ago. We can then prepare the IRS year-end tax return for filing with the IRS, providing supporting documentation to increase the likelihood of a faster IRS response time and approval for the full refund requested. This process can take up to 90 days. FIRPTA Refunds likes to believe that we offer the lowest pricing on absolutely the best FIRPTA services out there, with the speediest response and result times. Experience when it comes to FIRPTA and the IRS really matters. With up to 90-day response times by the IRS, mistakes and under-supported filings can cause long delays. When a foreign seller finishes the IRS tax aspect of the taxable transaction, at this point, they are done. Thank you for watching. We become foreign seller representatives. We welcome buyer, seller, their agents, and or closing company inquiries when the need arises. It is easy to contact us for a free consultation. Don't forget to check out our other videos online and our website at FIRPTArefunds.com.